right, Rex, I am so excited to talk to you. Thank you for spending the time to jam with me.
Of course, one of my favorite investors, newsletter writers, my former office buddy. I don't know if people know that. We used to share an office at Index back in the day. I'm not sure how productive we were, but definitely some good bonding times. So no, great to talk. I think it's great that I've enjoyed the episode so far.
Yeah, no, I love this. Well, one of the things too that I feel like I end up talking about you all the time because when people talk to me about writing and why I write and I'm consistent, whatever, I said, well, I had a very good friend who's a much better writer than me and has a much more successful Substack than me that once gave me the advice where you just have to set a goal and just try and not miss a week. And if you can just reach that goal, you'll
Yeah.
pretty much everything else will take care of itself, like growth and people following and whatever. Like you just consistently write. And so that one, I was like, all right, like first week of 2022, I started writing, haven't missed a week. Every single time I talk about that, I always end up talking about you. So I appreciate your inspiration.
Well, thank you for saying that. I mean, it's first very impressive that you've been so consistent. I feel like I've definitely missed a few weeks in there. But I think I kind of grew up with my dad always saying, what's the quote? Like, there's no such thing as good writing, just good rewriting. And I always liked that. I feel like it's also kind of true that, well, first, I think it's a famous author's quote. I don't know the famous author, but for me, it's Derek Woodbury's
Your dad is
quote,
the
my
famous
dad's
author.
quote. Exactly. But I think similarly, it's kind of like you and I probably both read our pieces from like 3 years ago and we're like, yikes, like we were not very eloquent and like we've improved and we've gotten more concise and punchy. And I think that's true too. Like there's no such thing as like good, early writing when you get going. Like you kind of just hone your craft over time. And I think the internet is cool because you can build in public and kind of create serendipity of meeting other interesting people and founders and thought thinkers who share similar views. So nice work for you with that consistency. I mean, I'm a huge fan of reading it.
Well, I appreciate it. Well, and I think that one of the things that I have noticed about really passionate writers is that they often struggle not to pursue the types of things they're writing about, right? Whether it's like you write about the
Mm.
things you're most interested in, but even more so interesting to me is when you're writing about things, you often find yourself thinking like, man, yeah, I agree with what I have this quote pinned to my Twitter profile where I talk about like, I write because I don't know what I think until I read what I say. And I find that sometimes when people write really consistently and they read what they say, they think that's a really good point, and then they go do the thing that they're writing
Totally.
about. I
Totally.
feel like, and so I want to talk about your fund because what I love about following Daybreak is that I feel like you have lived that to a T, where like your writing had a very specific, passionate, artisanal is the word you use that I love. This sort of like very artistic sort of embracing of the types of companies you want to be investing in and building and the type of strategy you want and stuff like that. So I want to talk about how Daybreak formulated it in your head as you were writing and thinking about venture.
Yeah, I mean, it's interesting because I do think one trap that is easy to fall into as a venture capitalist who does a lot of content and writing is that we all fall in love with our own theses. And you can maybe meet a founder who read that piece or who just shares a similar view and they tell you the same thing and you're like, wow, you're brilliant. And like you obviously you think it's brilliant because you wrote it and like you put out that thinking or framework and we're all in love with our own ideas. And so I feel like one lesson I've had to learn over the last few years is like usually the best entrepreneurs are smarter than me and deeper than me. And, if I write about healthcare, if I write about commerce, like they are 6 levels deeper. They are living and breathing this every day. Whereas you and I context switch between different industries. And so I usually try to kind of take it at face value and learn something from every conversation with the founder and get a unique insight because I think you have to be careful about that when you're building in public or writing in public so much. That probably didn't answer the full question, but I think that's just one thing that I've tried to think about over time. But definitely, I think it is a forcing function for synthesizing thought. And my view, I think I've told you this before, is like, even if no one read what we write, hopefully it would be a productive exercise for us. And this is true for investors. It's true for founders. I think it's true for anyone where kind of writing long form prose forces clarity of thought and forces a prepared mind. And hopefully when you and I go to meet founders or go to help our companies, because we put together a piece that kind of succinctly shares a view or framework and we put a lot of thought and energy into it, it forces us to kind of get up to speed and build our own perspective on something, which is then productive for that conversation.
So obviously both of us came from Index and we're very grateful for the platform that gave us and the learning experience that we had there and obviously bringing us together as bosom friends. But I think that the fact that, I mean, I'm curious to understand this from the digital native perspective, because anybody who reads my writing, I feel like sometimes I am like a grumpy old man on a soapbox. because I'm just complaining about a lot of the like perverse incentives of venture and the business model of blah blah blah. So like investing style is like the core thread, and like investing philosophy and whatever is a core thread of all my writing. And so when you see that I went from having spent 10 years working at really large established
Yeah.
firms to joining a much smaller firm with a very specific focus and strategy and kind of a product centric view of the world and how we build our platform, that feels like a no brainer for my writing. For the way that you built Daybreak, I'm curious what the like, because typically when you want to start something new, as much as we love the firms that we've come from, the reason to start something new is because you feel like there is a counter positioning that you can do. There's a hole in the market that can be filled by a new fund, a new approach. Your writing is not explicitly always about venture investing as a discipline, and so I'm curious what about your writing led to the formulation of Daybreak as currently constituted. Like what did you learn through writing that made you think like this is the opportunity that exists in the market for Daybreak?
I mean, I think we've seen certainly kind of an unbundling of venture in a lot of ways where it is less about the monolithic firm, especially as they get bigger, and much more about the partner that the founder is choosing and the person. And so I think writing gives an advantage or any content. And some people can take this in different ways. Like some people are really good at content. Some people are really good at networking events. Some people are just meeting tons of people over Zoom and super connecting. But I think you lean into what your advantage is. And then, it's really about the founder choosing you and understanding that you believe in them, that you're going to be there, that you're going to be a long-term partner. And so for me, like part of it was that kind of vertical integration where I think over time in this job, you realize like, okay, I feel like I can source, I feel like I can pick, I feel like I can win, and I know I can partner. It's not Rex Woodbury Ventures or Digital Native Ventures. Like it was never interesting to me to build kind of that more solo GP super angel practice. I do want us to build a franchise. And I think Daybreak will never be the 50-person index or 500-person Andreessen, but we will be 3 to 5 partners long term and more kind of learning from the artisanal venture players. That's what I call them of a prior generation. Union Square Ventures, IA Ventures, Floodgate, Founder Collective, a lot of the firms that we admire for being really specific with their craft and really disciplined and lean in early stage. And we talk about perverse incentives. I mean, I just think that is the purest, most incentivized form of venture capital. Like the earlier you get, the less it feels like capital allocation and the more it feels like being a partner to company building and really getting to sort of have a point of view of where the world's going, really believe and have conviction in a person. And I'm usually investing at incorporation or when it's like 2 founders and, a slide deck. And I think that's great. I mean, I think that like that's the most exciting part. And the incentives are very aligned in that it's not my name on the door by name, but a proverbial name on the door. And so, every Daybreak investment means a lot more and is more high stakes for me than I think, a lot of the big shops where there are incentives where you get promoted if your deal gets marked up or other things like that. But it's less about treating this like the 10-year time horizon that it really is.
Walk me through the thesis of Daybreak. There's been some great pieces that you've written. You got covered recently as you announced the launch of the fund. And so there are some articulations out there, but sort of from the horse's mouth, how do you think about the Daybreak thesis and how you're sort of focusing your strategy?
Yeah, I mean, I think thesis is first capital in, first partner to founders as early as we can be. Of course, we always wish we could be earlier and sourcing is never perfect, but my job is really, can I find the exceptional founder right when she's ready to start her company? It's very often pre-product. It's often pre-incorporation. Like sometimes the company doesn't even have a name, but can we be the first thought partner in sort of thinking through the business model, product, distribution? Can we, yes, give capital, but also help hire the team, help bring on early customers? Really, I think just being like a consigliere is the best thing you can do as an early venture investor. The best founders, like my view has always been, they know how to run the business. Like if Kyle and Rex did not exist, they would still build a really special company. It is not our job to tell them how to run the business. And I think this is sort of from the Index playbook too, where Index is made up of a lot of kind of career investors. And I think we all recognize that investing is quite different from founding a company and running a company. And we're not going to overstep and, try to handhold or tell you what to do. It's can we do the 1, 2, 3 things that really move the needle for success in this company? I had one of my companies recently where it was like the founder had gotten it to really good scale, largely as a one-man band, but like he really needed a head of growth. Like the single highest value thing I could do is bring a head of growth. And I was able to bring in one of my friends to join as head of growth, and he's inflected the business and they're crushing it. It's really like one or two key hires, maybe one or two key business model insights, one or two key customers. Like I think for us, it's really focusing on the things that actually matter. And first rule is do no harm. Second is, really hustle and be available.
Yeah. Um, and I think that part of getting there as early as possible, because one somebody tweeted recently that they said the job of the VC has changed fundamentally, where like analysis doesn't matter anymore because we have ChatGPT and deep research. It's all about access. And increasingly that has been true. That like, yeah, like access is important. I also think though, like that's a super dangerous precedent to set to
Totally.
say that like we don't need any analysis because it's predicated on the assumption that once you get access, the good will be known and it's just a matter of like making the investment. And
Hmm.
as we've seen, there is a myriad of bad that looks a lot like good,
Hmm.
whether that's
Yeah.
bad businesses, bad business models, or just like bad founders who are really good at selling and marketing, but are actually terrible business builders. And I think that ties in really well too to this idea of like thesis driven investing. You talked about this idea of like the danger in being really prolific and writing a lot is that you kind of get excited about your own thesis that you've maybe spent a lot of time fine tuning, which I absolutely have fallen victim to. Of like, I have to be really careful about. Like, I often talk to my partners about there's a difference between the pitch that I'm hearing and the pitch that I'm giving myself in my head, where I'm like, yeah, if this was this and this and this, it could be really cool. And my partners are
And
like,
you're
right,
like, is
they
that what
didn't
is that?
say
But is
that.
that what he said? Exactly.
Yeah, yeah.
Yeah.
He doesn't want to do that. They don't want to do that, right? And I want to talk about like from your perspective, when you're writing about things, the negative version of that is what we talked about, which is like falling in love with your own thesis and hearing what you want to hear. The positive version of that is that I think it's like Arthur Patterson, one of the founders of Excel, talking about like building a prepared mind, which a lot of
Hmm.
people talk about now of like, we have a prepared mind. And it's like, I feel like you think you have a prepared mind because you read or heard that this company is hot and now your mind is prepared to be excited. Like maybe that's what you're prepared for, but you haven't actually dug in. I think you are a really unique example of, I think even in your announcement, you talked about like, I've written about this and then I went and invested in this. What is that prepared mind exercise like for you? And has it been fruitful? Has it been so?
Yeah. I think I have a couple, maybe two things to say to what you just said. So, first, I almost referenced that tweet that you're mentioning earlier when I was answering about sort of incentives. I think, I forget who did the tweet, but I think Rick Zullo from Equal responded to it and said, this is the problem, right? Like, every hot deal is becoming consensus. And this is an industry where you're becoming rewarded for knowing where the heat is and knowing what the hot deal is versus actually building independent conviction. And part of it is the incentives that we've talked about, where maybe to get promoted at a multi-stage, you need to beat out Andreessen or Sequoia or Index or whoever on this hot deal and then get a good markup. And by the time you're a GP, it doesn't matter how the company actually does because you're a GP, right? Like there are perverse incentives. Whereas I think when you work for a smaller fund or a newer fund like Contrary or Daybreak, it's much more like, is this actually going to return capital in 10 years? Is this actually going to, be a really generational company? And I think that's the challenge where conviction is very different than consensus. And I wrote a piece that referenced a founder collective chart that they had put together and that I've discussed with them, which basically tracks kind of like the hot sector of the year versus like the biggest company born in that year. And they're very rarely the same, right? And so one question for us with AI being this really frothy moment right now is like, okay, well, what's non-consensus, but what's going to be the really frothy thing in 2026 or 2027 or 2028, right? Like, is it longevity and health? Is it, some form of fintech again? Is it consumer? Like, I think those are kind of interesting thought exercises to have because it's really easy to skate around where the puck is now, but like, where is it actually going? So that's just one kind of, rant about the incentive structure and venture and what we've talked about. And I always tell founders like, when I'm trying to, partner with them, I'm like, and it matters a lot to Daybreak. Well, first of all, I will certainly be here in 5 years or 10 years to partner with you. Whereas I think there's so much turnover at these firms with the partner that investors or that founders get. But also like $1 million doesn't matter much to the Andreessen Horowitzes. It matters a lot to the Daybreaks. It matters a lot to the Contraries. Now to answer your actual question, I mean, I do think that writing tells the world what you're interested in and sort of activates your network and helps you build theses that then use the word serendipity earlier. Like one thing I often say is manufacture serendipity. So if I can write about a topic I'm really interested in, hopefully when a founder is raising her round next week in that space, someone whispers in her ear and says, "Oh, you've got to meet Rex at Daybreak. He was really interested in this. He's thought a lot about it." Some examples. I mean, the first lead investment we made out of Daybreak is in a company in the resale commerce space. That's one where I had written quite a bit about the sector and the opportunity in resale and how there's a mismatch behind, it's the fastest growing segment in commerce, 11 times faster than broader retail, all of these tailwinds on sustainability and Gen Z, and really just like a fast growing space that is completely mismatched from the size of outcomes there. So I said, someone's going to solve the supply side here and fix this. And an angel here in New York was like, "You've got to meet these two women. They're starting this company. They're amazing." So I think that's kind of like almost one way the Whisper Network can help and work. And similar things have happened. Like I was looking for a really long time for a company in dermatology, just given all of the tailwinds happening and sort of a more visual culture and skincare. And then a founder introduced me to David at Honeydew. And that was exactly what I've been looking for a year and sort of pounding the table and talking my mouth off about. And that's happened a few times. And I think that is not always true. Like I've certainly done companies that I had no idea that the opportunity existed. Like I had one company in the animal health space. It's called Barnwell. They basically are doing biosecurity for farmers to understand the health of their livestock and poultry and mitigate the spread of disease. And I was by no means building a thesis and thinking through animal health in that way, but like I was reactive when I met a really great founders. I think you have to be reactive, but also proactive and balance both in this job.
On that point, I have never had this happen like so immediately. You and I were talking about this as well, but a week or so ago, I tweeted a thing about something sad about dating or whatever, and said like it really feels like there is $1 trillion opportunity to be built in like actual matchmaking, like AI
Yeah.
driven matchmaking of like finding your real partner, not in like dating apps. They're just trying to keep you on dating apps and stuff. Like just a casual thing, not even something I'd say I've written a ton about. One of my partners, Will Robbins, has talked a lot about it. He and I have talked a lot about it. But I just tweeted that, and a day later, I got an intro to a company that was already raising and jumping into it. And so, like,
Yeah. Yeah.
very rarely, to your point, like that sort of manufactured serendipity can be really powerful. And you always think to yourself, like, I've had these. If you just think, you always think to yourself, I've been thinking about exactly that. Like, why didn't
Yeah.
they reach out to
Yeah.
me? Or why didn't I get in touch
Totally.
with them or whatever? And it's like, if you don't put it out into the world, that serendipity can't happen.
Yeah.
But the other thing that I think I wanted to like drill into is on that point of like, oh, analysis is dead. All that matters is access. And it's like, no, like you actually have to form like a well-crafted opinion. I'm curious if and I have a story about this too that makes me think about it, but I'm curious if you've had the experience of like you explore something that you think is really compelling
Hmm.
and then you talk yourself out of it. Like you realize like this is not as interesting as I thought it was. Like you're writing about it, or maybe you have written about it before. You go look at the companies and you're like, hey, it feels like there are because one of the things I think all the time about is this idea of like you have to be contrarian and right, but like that being right moniker is like so multifaceted. Like it's not just like it's the correct idea. It's like the right idea at the right time with the right people in the right way with the right model. Like, there's so many things. And so like you can be conceptually right and intellectually right, but like practically or tactically wrong. And so I'm curious like if you have found ideas that you
Yeah.
also end up being wrong about.
I mean, I definitely have talked myself out of many things. And I think, this is the classic part of the podcast where people talk about how you can only lose 1x your money, but you can make 1,000x. And I mean, the way I would frame that is growth investing, private equity investing. I think they are very much forms of pessimistic kind of driven investing or what can go wrong. And venture, especially early stage pre-seed seed, it's much more optimistic investing. It's what can go right. And for me, I always do kind of an analysis of the what you have to believe is what I call it. This actually comes from I used to work at TPG, which was much more kind of like a very diligent, driven culture in late stage investing. But I think it drilled into me this idea that you do have like usually for every company like 3 to 4 things that you have to believe for it to actually be a multi-billion-dollar outcome. And maybe it's market timing, maybe it's something around the business model, maybe it is something around the founder, but then you can kind of hone your diligence process around getting conviction around each of those being risk reward adjusted enough that you really can have conviction in this being an interesting opportunity. And I think, always like too many people anchor on the concerns. Like there will always be lots of reasons this couldn't work, but the question is, it's a power law industry. Like if it works, will it really, really work? And then I think it just all comes down to the person. Like I'm just a very founder centric investor.
Yeah. So my experience I think plays well into what I want to talk about also, which is like kind of the broader evolution of like the business model of venture.
Hmm.
But one of the things that I've really struggled with is for a long time, there's sort of this like evolution of like, I think I've had maybe I don't know if it's the naivete or the idealism beat out of me over the last 10 years. But I used to really think about, so like I write all the time about storytelling. And I used to think that like, hey, like reality will win out in the end. Like,
Hmm.
it's the sort of Warren Buffett quote of like, in the short term, the market is a voting machine. In the long term, it's a
Yeah.
weighing machine. Like eventually you will be, it's like a Knight's Tale. You will be
Yeah.
weighed, you will be measured, you'll be found wanting. I really truly believe that. And then increasingly, I felt like, oh, actually, like storytelling is pretty important. Like reality is so important, but like you really have to understand storytelling. And then eventually, I have kind of come to the like, I don't know if it's pessimistic or just whatever, but I've come to the appreciation of the fact that like storytelling can shape reality. Like it can turn it into a real thing. And the same thing has happened, I think, with maybe not every business, but a lot of businesses. I can think like there have been a number of businesses, and as early stage investors, like we're not in the business of shorting companies, right? But all of us have had those companies where you're like, man, if I feel like if I could bet against this company, I
Hmm.
would. Like I don't want to, and I'm not going to talk about it. I don't need to be like raining on people's hustle because it's hard to do this no matter what. There have been certain companies where I'm like, man, if I needed to bet against a company, that might be the company I would think is just not going to work. And I have been proven wrong over and over again. And especially where I think like there's two companies, and I think this one is a better business, this one is not. But the founder of this one is just not as good at fundraising and is not as good at storytelling. And this one is incredible at fundraising and incredible at storytelling. And in my head, I'm telling myself eventually that, this is voting, like, or these early rounds and big markups and whatever, like that's voting. But in the long run, it will be proven out.
Hmm.
And that just has multiple instances I've been burned on that because it's just not true. And maybe it was true 10, 20 years ago when like capital was not
Yeah.
um, as much of like a halo effect. But in the market we exist in today, you could have two identical businesses, but one has a better product and one has a better fundraiser.
Yeah.
And as long as this product is not so bad, and as long as this founder is truly not good at fundraising, I probably would bet on this one being the successful business.
Yeah.
I don't know if you disagree with that or if you push back on that.
I mean, it's tricky because like we are in the early days, you're building a name, a brand, a product, and sort of you're right, you're telling like the narrative. And so much of our job in venture is sales, right? Like we're selling to LPs, we're selling to founders, why to work with us. So much of a founder's job is sales, right? He's selling to us. He's selling to his employees to be the early joiners. Like I think the best, like you and I both used to look at lots of companies where we would really like the founder, but then the feedback maybe internally would be, yeah, but they're not very commercial, right? And like the founder has to be a right fit. That's okay maybe for some deep tech or infra company or something like that. But if you're going to be doing B2B sales all day, or if you're going to be, trying to market a consumer product, or if you're going to be in any way like the face of this business, you do have to be pretty commercial. And really you need some level of salesmanship to be able to sell hires, to sell customers. And so it is a learned skill. And I think you can invest in someone very much based on the slope versus the intercept. But there needs to be some baseline level of storytelling. And that's really a lot of what startups are. And like, I do think a lot of the best venture firms are really good at manifesting that, right? Like, I think, Andreessen, Sequoia, like, I think a lot of times when you declare a company to be, the winner in a category, like it can be self-sustaining if the brand starts taking off and, or self-fulfilling rather, and then it can sort of become reality by attracting the best talent, by customers saying, yeah, we've heard of you, but like, everyone's talking about, this one. And like I'm trying to think of like a really good example. I'm struggling a little bit. I was thinking Ramp for a bit, Ramp and Brex. I was thinking Cursor and other tools, but like it's tricky too because brand really at its core is an extension of product, and like those are better products, and like the brand is so strong because of product, and so it's very hard to extricate those two things. But eventually, once the lore starts farming around this is the better product, this one's shipping faster, it starts spinning faster and faster by attracting really good talent and logos.
Well, and I think that because yeah, and the examples that I had thought of were things like actually I thought an interesting case study was the design space where
Mm,
there's like Envision and Figma. Figma was fundamentally a better product. And Envision ran faster and was louder and got bigger quicker. But in the long run, the better product did prove out, right? I think a better example is to contrast two winners because
mm,
I think that Figma and Canva had dramatically different journeys And Canva was underappreciated for a
Yeah.
very long time.
Still is. Still is. Yeah.
Totally. Yeah, totally. Incredible business. And I think that what that indicates to me is this, because like, yeah, I think that Canva it was actually really funny. I didn't realize this until maybe a year ago. What's his, I think Guy Kawasaki, who he wrote like The Art of the Start or whatever. And he was like an evangelist for Apple. And like now he's the chief evangelist for Canva. And I've written a few times about like I think that role of like chief evangelist is really interesting, doesn't really exist today. Like everybody's just like Lulu Miservi talks about like the founders have to go direct or whatever. But I think there is an element of like you could be better at productizing storytelling in a way that most companies don't. And I think Canva for a long time struggled to do that. And it was the organic lift that they had because the product was so good that eventually got them to
You
this like
can't
ultimate.
ignore it anymore.
That's right. But for a
Well,
long
it's also
time, it was not appreciated.
yeah, I mean, I think it's also a geography thing, right? Like, I think they're from Australia, really kind of like a little known story in Silicon Valley and in the US. And eventually you can't ignore the products, the product numbers and metrics. I mean, I think, they're what, 4 billion more of revenue now. I mean, really growing quickly still, obviously a much more known consumer brand too than Figma. But Figma's an amazing company as well, but it's in Silicon Valley. It's attracting great San Francisco talent. It's a few blocks from all the VCs. So I think it is a bit of a different narrative there. But you're right. Like I think you can have multiple winners that come about in very different ways. And there are a lot of really large companies that you and I both will see IPO, but like we'd never heard of because it didn't really wasn't on VC Twitter or wasn't sort of in San Francisco or those kinds of things, right?
Totally. So this is a good segue into the last sort of bucket of things I want to talk about, which is like the business model of venture changing. And I think the reason that this ties in really nicely is because we go from like, okay, it feels like the sort of best product wins over time
Hmm.
to, okay, like storytelling matters quite a bit to now, like, I feel that, and you presented an interesting framework that I had not really thought about, but I think is totally accurate that like proper growth stage investing is sort of pessimistic from first principles, where you're really trying to think about like what could go wrong. And usually the reason for that is because if you're investing $100+ million, that can't go to zero. Like that's just like, that's too high
Yeah.
of a risk, right? The,
Yeah.
the cost of capital is too high. And so you're trying to think, okay, well, how do we make sure this doesn't go to zero? Then like, yeah, there's an upside case that we can underwrite to. But what we're primarily focused on is like the sort of base case of like what could go wrong and where could we end up. And then venture is much more optimistic because like there's just nothing to go on. And so you have to be excited about what could this be, what could go right, whatever. I think that there is this like mutant hybrid that we now have where you have folks who are operating at the scale, like firms that are operating at the scale of what 10 years ago would have been like growth equity, financial
Totally.
engineering style investors. That's the capital scale. But the mentality is still very much venture investor. And so they still think about, like, they're not thinking about, and there's two reasons for that, I think. Number one is they can lose $100 million. Like, if you're investing out of a three, four, $5 billion fund, like one fund, 100 million bucks is a rounding error. Like, it's maybe not, doesn't feel good, but like to your point about like, hey, like $1 million doesn't matter to these big firms. Yeah, like $100 million barely matters to these
Yep.
firms.
Yep.
And so when you can deploy that much capital, you can afford to be optimistic because if you lose it, it's not as big of a deal. But to your point, if you miss it, if you miss the
Hmm.
one, you
Totally.
could miss out on 1,000x your money. The danger though is that if you think about, okay, what is the like mentality of that type of firm? And I've written a bunch about this of like capital agglomerators and the business model of how they think about
Hmm.
things, whatever. And it's like that business model is what is the loudest thing that's growing the fastest, that looks the sexiest, the hottest. Like you have to be around those things. And eventually you see how that model breaks down when you look at like these companies at scale. Because what's so fascinating to me, and I haven't laid this out yet in any of my writing or whatever, but it's if you look at the cap tables of OpenAI, Anthropic, Cohere, Mistral, X, most firms are in all of, like Andreessen, I think is in like three of those five or whatever. And like
Yep.
Sequoia is in three or four of those five. Like once you get to that scale, you realize that kind of exposes the
Hmm.
business model for what it is, which is like, it's just absolutely
An index
coverage
fund.
investing.
Yeah.
Yeah, totally.
Totally.
You're just like, we just can't miss the things that, and we have enough capital that we can just put it everywhere. But the perverse incentive of that is two things. Number one, like it gives companies that maybe shouldn't have as much money a lot more money, and that becomes problematic and maybe even damages the business because they have so much cash that they act less responsibly than they would have otherwise. And number two, there are a lot of great businesses that smaller funds can invest in, and that could be three, four, $500 million outcomes, and that's great. That can be life changing for the. We were talking about this earlier. Sheil posted a tweet that I'll link to where he shared a screenshot of all the early Sequoia and Kleiner and
like 5 million fund ones.
Yeah. 5, 8, 25, $35 million funds, right? And these are putting up 30, 40, 50 X's, 100+% IRRs. Like they can really compound capital. So for a fund, those types of outcomes can be really great. For the founders, they can be life changing. The employees, it's great, right? But once you start dumping billions of dollars onto those companies that they just don't ever really justify, like they're not going to be a $10 billion company structurally. Then you damage the outcome of a generation of companies.
And I think founders need to know the calculus that's happening, right? From a multi-stage firm versus a pre-seed firm, a seed firm, right? Like I think, a $1 billion outcome is a big win for a 30 million, 33 million fund like Daybreak Fund 1, right? It doesn't really move the needle for Andreessen Insight, et cetera. Like there was another tweet that was going around, right, around Wiz and Insight stake in Wiz. And, Wiz is the largest VC-backed, acquisition ever at 32 billion. It breaks the Facebook WhatsApp acquisition at 19 billion. And it's going to return like a third of Insight's fund, which is crazy. I mean, you compare that to, I'm sure it's returning multiples on Index. I'm not sure about Sequoia, how big these funds are, but like those were the largest holders. But then you look at someone like Cyberstarts, which put in 6 million or something and gets like I think they had a 50 million-ish fund. They get a 22x, 26x or something like that on it. I mean, those numbers are crazy. And so, I've spent a lot of the last year fundraising. And so I tell LPs, like, I always appreciate it when LPs know the math around emerging managers, right? I think there's a certain class of LP where you might just talk to them a bunch, but like at the end of the day, like they're going to invest in Andreessen's new fund or, Coatue or Insights or General Catalyst. Like that is the product they want. And it is a totally different product from the one we're selling. We're looking for those small funds that can be 10x, 15x, 20x funds. It's a lot safer maybe to get the 2 to 3x from those firms, which are much more like private equity now, but it's just almost a different asset class. I like how, and when we're competing, I mean, it's different too. Like I like Mike Maples, I think said on stage once at an event I was at, he said to a multi-stage guy, he was like, you and I are both in the same industry, but we're no longer in the same business. And I always think about that the same way where it's like,
that's such a good quote.
Yeah. I mean, like I'm in the business of like, can we get huge multiples on smaller funds by owning good percentages of generational companies? Not necessarily just the safer, 2 to 3x. And of course you have to believe in the power law. You have to have enough shots on goal to allow for the power law to work. You have to have enough ownership that when a company does work, it moves the needle for your fund. I think a lot of that is the portfolio construction math that you have to think through as a fund manager and that founders should be aware of as well. But there are a lot more ways to 10x a 30 million fund than a 3 billion fund, right?
The other thing that in my writing that I have always hesitated to do is to like pass judgment on these models because they can work. Like there's clearly a reason, right? I got in a fight with Brett Adcock, who's the CEO of Figure, the humanoid robotics company, because I tweeted something about, I think it was Fred Wilson or somebody talking about how we need more people deploying $100 million funds and not deploying $1 billion funds.
Yeah.
And he was like, yeah, if you want like, incrementally better calendar apps, then sure. But if you want like robotics and nuclear energy and whatever, like you need big pool. And it's like, that is a totally fair point. Like if you want to chase really ambitious stuff that's going to require billions of dollars to be able to pursue, it's great that those firms exist. I feel like increasingly the most important thing, and it sounds like you do too, based on like founders needing to understand this, is one of my pieces I wrote about the unholy trinity of venture capital. And it's like there are capital agglomerators who have massive multi-billion-dollar funds. There are yield farmer LPs who like they don't care about venture scale returns. They care about like 4, 5, 6% yield. And there's these capital absorbers who are like, I need to suck up as much money as possible. And they're kind of perfect for each other, right? Like LPs can deploy $200-300 million a pop into these funds. These funds can deploy $100 million a pop into these companies. These companies can raise $1 billion+ at a time. like go nuts. Like that model can maybe chase great stuff. Let's see how those all turn out. But like I think Uber is a good example of like, I think they proved it. Like I think they proved that that model can work because now there's, everybody criticized them even they were, were public and not profitable. But like now they're spitting off cash flow. Like
Totally.
that can work. The danger is when you have companies who think they're capital absorbers and they're just not, or funds who think they're capital agglomerators and they're just not, or LPs who think they're yield farmers and they're not. Like that's dangerous.
There is certainly a customer for the insights or general catalysts or Andreessen's, right? Like I think someone had responded to that tweet about Wiz. Yeah, but think about the dollar's profit, right? And like that is some of what matters for a lot of LPs. Like it is not the multiple, it is the actual dollars and the billions of
Yeah,
value
just
created.
yield.
And totally, totally. And I think you and I are more on the side of venture, which is more about the multiples. And I think, yeah, I mean, if an LP puts 3 million into Daybreak Fund One or Fund Two, like my hope is that I can turn that into 30, right? Like, or if we really hit it, you turn it into 60. Like, those are tough multiples to have in these later funds, and it just attracts a different type of LP. And sophisticated LPs maybe balance the two and understand that both have their advantages. I mean, I think from the company perspective, sure, like yeah, there are certain types of companies that will absorb tons of capital and are going to be super capital intensive, but like a lot of the best company outcomes, like, started pretty small. I mean, Uber, you mentioned, what was their first capital round? Maybe 10 post, maybe even smaller. I mean, I think, yes, there's a bit of a J curve, a bit like a many year J curve with a lot of these companies. But if you get in early, it can be a really beautiful thing. And that's also when I think venture is less capital allocation and more actually, can we help hire the team? Can we help give insights on different business models? Can we help say like, look, you're an N of one. We have a portfolio of a bunch. Like we'll tell you what's worked and what hasn't worked and just help be consigliere here. That's the purest form of this industry in my mind.
Yeah. Two final questions for you. Number
Mhm.
one, you're just coming off of fundraising. In your experience, do you feel like LPs are sort of evolving their thinking as it relates to that? Like maybe some LPs are starting to appreciate like, hey, it used to be that like,
Mhm.
getting into these big funds was kind of the old school IBM effect of like, well, nobody gets fired for putting money in
Yeah.
Andreessen or Sequoia or whatever. And now they're realizing like, you know what, I may not have the capital base to justify that return profile. Like, do you think that mentality is shifting or is everybody still just like, well, we got to get into the big ones?
I think that it's not one size fits all. Like, I think you just have to find the LPs who are fit for you. I spent many hours of my life probably talking to people who were never going to get there on Daybreak Fund One because they didn't have venture exposure, but they were thinking about venture. But at the end of the day, they're probably going to go with established names before they really think through, a fund one or emerging manager strategy. And then eventually you kind of realize like you become a bit more judicious in saying like, when's the last, emerging manager you backed? Have you made a new commitment to manager in the last 2 years, right? Like I think it sort of starts weeding out a lot of folks who, I forget who said it, like at some emerging manager group, like you have to weed out who's curious versus who's serious. And I think you really need to see like, are they just putting you in their CRM because they're curious and maybe they want some deal flow, or are they actually really excited about the potential asset class at really, really early stage and smaller funds? So I think I got a little bit better about sussing that out and judicious, but it really is just a lot of meetings and some percent convert. And it gave me a lot of empathy for the founder fundraising process too.
Yeah. Final question for you. If you were advising founders as they're trying to navigate, because one of the things I think probably you and I take for granted is that we think about this all the time. Like it's part of our business is we have to understand how LPs think about things, how we're structuring our fund and portfolio strategy and who we're competing against and whatever.
Hmm.
Founders fundraise, maybe once every year or 6 months,
Yeah.
depending on who you are, I guess. But it's just those isolated incidents. So what advice would you give to founders to better understand this ecosystem as they're trying to pick and choose what is a good fit for them?
I mean, I think first just understanding the incentives and the power law and everything we're talking about with venture, right? Like venture is not the right product for a lot of different companies. You would make a lot more money probably bootstrapping and selling for 50 million or 100 million versus, owning 6% of a company at IPO. I think there was some stat around, maybe it was the Lyft founders or, some table I saw around ownership at IPO for some of these companies. And you would make a lot more maybe with a smaller business outcome, but owning more. And there were perverse incentives, right? Like when you and I back a founder, like it doesn't move the needle for us to have $100 million acquisition. We really want that company to swing for the $1 billion outcome, the $5 billion company. And I think founders should just be aware of those incentives and also understand the type of capital they're taking and what the goals are for the business and for themselves. So that's one piece. And then, I mean, my view is really like it is all about clarity of thought, a founder market fit, a unique insight. Fundraising takes care of itself when the product or thinking or strategy is there. And so the big watch outs are just, I think fundraising for the sake of fundraising or playing the game of trying to raise more and higher prices. I think it's much more around let's focus on the things that matter, like celebrate new customers, new revenue. Like, we used to talk about this in venture too, of like a lot of venture firms will celebrate winning the competitive deal. And great, like maybe it deserves an email or a pat on the back, but like that's when the real work begins. And I think similarly for companies, we've seen so many in the 2021 frothy days of like, almost like Coachella lineup pictures of like fundraising rounds and we'd raise this much from these people. And it's like, okay, but like now we have to return multiples on that. And like, let's celebrate hitting 1 million of ARR or 10 million of ARR or like benchmarks that actually really matter. And I think the industry needs to get away from a little bit of the froth and hubris around that and focus on outcomes.
Amazing. Well, Rex, I'll post to your Substack, Twitter, LinkedIn, all the things, Daybreak's website. But thank you so much for joining me to chat.
Of course, of course. No, it's a great discussion. I mean, I learn a lot from reading your writing and, look forward to doing it again sometime.
Same, man. Thank you.